The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances. And with that, let's get to this week's episode.
Hi, I'm Jason Nickerson, President and COO, and this is Financial Focus. In this episode, we're exploring the collapse of Silicon Valley Bank, Signature Bank, and other discussions of the banking and financial institutions during this period of time that started just a few days ago. Okay, so first, let's start with kind of what happened in general, right? Is understanding how banks collapse is the word that's being used, or banks get taken over by the federal government. There are a few different ways. But we'll go into some specifics around SVB, Silicon Valley Bank. But first, let's understand that this happens from time to time. Actually, the last bank that failed was in October of 2020, Ullman State Bank. So these things do happen. And how do they happen? Each bank can be a little bit different. What we need to understand is that banks are a business. Their job is to bring in revenue. And how do they bring in revenues? By bringing in deposits from depositors and then loaning or investing that money to earn more money than what they're paying their depositors. And that creates profit. In Silicon Valley Bank's case, they brought in depositors by offering some higher rates than usual and then investing that money in some specific ways. Their primary community of investment was the startup community, venture capital community, tech community. And this can be a volatile community, especially when you're talking about tech startups. They also invested in longer-term U.S. Treasuries. U.S. Treasuries range from anywhere from a month all the way out to 30 years. And what had happened with Silicon Valley Bank is in investing in long-term bonds in a rising interest rate market created a situation where they were realizing that they had some unrealized losses on the books. So let's stop there for a moment. We need to understand how bonds work in general. Bonds have an inverse relationship to interest rates. When interest rates go up, existing bond values go down, and vice versa. As interest rates come down, existing bond values go up. So in this situation, as the Fed's been raising rates, investments they already made in long-term bonds, the valuations on those have come down. And depositors recognizing that these are the situations developing, we get to witness another scenario around something known as herd mentality. So it's a behavioral science term. So this is what happened. Is it the same exact across all banks? No, but what is in common is just bad investment decisions, and then depositors understanding that those situations exist, and so they go and try to claim back their deposits. Now, why have brokerage firms been brought into this conversation? Well, brokerage firms can have business functions similar to banks. But the question is are your brokerage investments, the accounts you've opened with big brokerage companies, are those safe or are those at risk? And the answer is, if the brokerage firm is operating prudently and according to rules, those are safe. And they're safe in a few ways. First of all, there is a Securities Exchange Commission rule that says brokerages have to separate investor assets from their normal functional business assets. And they cannot use those assets for lending and so on. Brokerage firms also join an organization that's federally funded and backed called SIPC, S-I-P-C, Securities Investors Protection Corporation. And that provides a base level of insurance to investors that trust their assets to be custodied with these brokers. And many brokers actually invest in excess levels of insurance under SIPC. So in general, if you have fully paid for securities, not margin accounts, but fully paid for securities inside of investment accounts, those are generally protected. So out of all of this conversation, what can you do as someone who's trusted banks with your hard-earned money and deposited your funds there, and what can we do to make sure that our brokerage accounts remain protected? Well, first and foremost, work with strong, well-known, well-funded banks and brokerage companies. And how you would know that is certainly you would have to be digging into their business operations, and that's not necessarily for everyone to do. So what do you do when you don't want to be doing that? Well, play by the rules of FDIC and NCUA. These are the insurance backings for banks and credit unions. And what those rules say is that each person with an account with an institution is protected up to $250,000. So a married couple can actually get protection of $1 million within their bank or credit union under FDIC or NCUA. One spouse can have an account with up to $250,000 in it. The other spouse can have up to $250,000, and then as a married couple can have another $500,000. And then if you're keeping more than that in banks, you can spread that amongst different banks and get $1 million of protection at each bank, or as an individual, $250,000 of protection at each bank. What if you don't want to keep that much inside a bank or multiple banks? Your next step is probably U.S. issued bonds, because the FDIC and NCUA are protected by and backed by the federal government. Your next step would be investing in bonds issued by the federal government. How can you do that? This would be going to a brokerage firm, again, that you trust, is operating under the SEC rules and has SIPC insurance protection, and investing in U.S. Treasuries, or using the online website of the federal government Treasury Direct and open an account there and invest directly into savings bonds and U.S. Treasuries. The third thing to think about in this scenario, and just because your deposits are protected and just because your brokerage accounts are somewhat protected from a downfall or insolvency, what you have to remember is your investments are still subject to market volatility. So many of us, even though we may have comfort in the broker that we're using, we saw our investment accounts fluctuate because of the market fluctuation, and that's something that you can't avoid. However, you should follow the rules of normal diversification, not becoming overly concentrated in one industry or one stock. And we've seen surprises like this happen before. If we go all the way back to the turn of the century, we had the dot-com bubble. We've had the mortgage and banking and financial crisis in 2008, and now we have another banking situation going on right now. So not having concentrated positions in these industries, in these affected industries, or in affected companies is always wise. So just real quick again to run down those things: deal with strong banks, strong brokerage firms that are well known, that they have the insurance in place, FDIC insurance and NCUA insurance with banks and credit unions, SIPC insurance with brokerages, and make sure that you are diversifying your investments. And with that, thank you for joining us on this episode of Financial Focus.